Hello everybody and welcome to this Sustainalytics webinar on our new sector report entitled Insurance, Shedding Light on New Industry Challenges. My name is Niamh O'Sullivan. I am a member of Sustainalytics thematic research team based here in Amsterdam, and I have the pleasure of being your moderator for today's webinar. We are delighted that so many of you could join us today, and I would like to extend a special note of welcome to those of you that have joined us for the first time. If you are unfamiliar with Sustainalytics and who we are and what we do, we are a responsible investment research firm providing detailed ratings and analysis on company environmental, social and governance, otherwise known as ESG, performance, so that institutional investors can use this information in their investment decision-making processes. One of the many things that Sustainalytics does is to produce periodic reports on the sectors and industries that can compile our research universe. These sector reports identify key ESG issues that we believe to be most material for the sectors and industries involved, such as insurance. They rate company performance against these ESG issues, showcase best practice, highlight leaders and laggards, and in general provide detailed quantitative and qualitative analysis that we believe is highly beneficial for institutional investors in their asset selection, allocation, portfolio construction, development, and engagement processes. I am joined today by my colleague, Mr. Doug Morrow, who is Associate Director of Sustainalytics Thematic Research Team based in Toronto, and also joined by my colleague, Silvana van Schenk, who is our resident Sustainalytics expert on the insurance industry. Doug and Silvana co-authored this sector report in association with fellow Sustainalytic analysts. And in a moment, Doug and Silvana will be presenting the main structure, key findings and takeaways of the report to you. This presentation will take approximately 30 minutes and will be followed by a Q&A session, with the aim of finishing the webinar at 5 p.m. Central European Time, if not before. Before we begin, I would like to highlight some housekeeping issues to you. This particular webinar ensures that each one of you are muted at the moment and will remain muted throughout the course of the webinar. This is in order to prevent any background noise and distortion. We would therefore like you to send any questions you have through the interactive panel you can see here on the bottom of your screen, indicated by the number 1. We will gather these questions on the presentation and the report and use these to begin the Q&A session at the end of the presentation. Incidentally, if you have any audio problems throughout the webinar, you can also notify us about those through this interactive box, and we will try to address them as soon as possible. If at any stage you would like to minimize this interactive panel on the side of the screen, you can quite simply click on the arrows here indicated by the number 2, and you will be able to view the presentation more clearly. Finally, this webinar is being recorded, and a copy of the recording will be sent to all participants over the coming days. So without further ado, I would now like to pass over to my colleague Doug, who will begin the presentation. Thank you.
Thanks very much, Niamh. My name is Doug Morrow, and I'm the Associate Director of Thematic Research here at Sustainalytics, and I'm delighted to be here today to discuss the findings from our recent industry report on the insurance sector. So in terms of an outline for today's talk, I'd like to begin by talking a little bit about the universe of companies we analyze in the report, and then I'll provide some insight into what we see as the major industry trends right now that are playing out for insurance companies globally. I'll then talk a little bit about the issue of climate change and where we see the major exposures in the insurance sector on this particular issue. I'll then pass to my colleague Silvana, who will walk you through our findings in terms of the key ESG issues that we looked at in the report and really constituted the thrust of the analysis in the report. And then we'll close out by taking a look at some of our top industry performers, concluding the major takeaways, and then we can have time for a Q&A, which hopefully will be a lively session. So let's take a look, first of all, at the universe of companies that we analyzed in our report. So we looked at 149 global insurance companies in our analysis, and as you can see on the pie chart, they're generally widely dispersed by geography, although there's a concentration in Europe and North America, and in particular in the United Kingdom, where we had 17 companies, and the United States. As in other GICS sectors, we found there's considerable diversity when we look at the universe through a more nuanced sub-industry lens. You can see here all 5 sub-industries that are associated with the insurance sector are represented, and it's increasingly important in our view to look at companies through this sub-industry lens when thinking about their potential exposure to ESG risks as well as opportunities. So our expertise as a company is obviously in ESG risk and opportunity analysis, but it is increasingly important to think about and view these issues in terms of a broader context, in terms of how value is generated in industries and what some of the top priorities are for executive management at insurance companies globally. So we always we're sensitive to this, and in all of our reports we make sure to tie ESG issues to some of these trends. So when we look at the insurance sector, we really see 4 major trends right now playing out that are dominating the attention of management and certainly the market. The first one is really the tightening regulatory environment that insurers are operating in and competing in. This is primarily manifesting in 2 main regulatory movements. The first is the Solvency II directive in Europe, which will have significant implications for virtually all of Europe's 3,500 insurers and reinsurers. The legislation right now is scheduled to come into effect on January 1st of 2016, and it's essentially going to set new capital reserve requirements as well as a host of new reporting and governance requirements for insurers. So it's obviously a really important short-term priority. And according to some analysis that was done a little while back by Europe's pension fund regulator, 1 in 12 European insurance companies are failing stress tests right now in terms of the new capital requirements required under Solvency II. So there's definitely some urgency that we're seeing in terms of companies scrambling to get their balance sheets in order. And the second major regulatory movement is, of course, the global systemically important insurers. This was announced way back in 2013 by the Financial Stability Board, which itself was set up, as the name suggests, to promote financial stability in the wake of the financial crisis. So the FSB identified 9 companies. They update the list regularly, but right now it's still the same 9 as were identified in 2013. Essentially, it's a who's who of the world's largest multinational insurers. And similar to Solvency II, these insurers are really required to meet a whole host of policy measures, again, tying into governance requirements and reporting, but more substantively, new basic capital requirements, and even more importantly, in our view, higher loss absorbency standards. Of course, the market is closely following what's going on, but the truth is it's really hard at this point to judge the financial implications of this regime, primarily because the most important measures, the HLA measures, the high loss absorbency measures, are not due to take effect until 2019. So there's still some uncertainties there. But as a proxy, we took a look at asset to liability ratio as a proxy for balance sheet strength, on the proviso that companies with a healthier balance sheet would be better positioned to absorb any type of capital buffer. And you can see there that even though we are dealing with the 9 largest and most heavily capitalized insurers on the planet, there still is a lot of discrepancy when you look at their asset to liability ratio. So, clearly, tightening regulations are a headwind for the industry, but I think an even more important headwind, certainly in the short run, is the low rate environment that has, generally speaking, characterized the financial markets since the end of the crisis in 2008. The reason it's a problem for insurers and life insurers in particular is simply because from an asset allocation standpoint, insurers are heavily concentrated in fixed income, and low rates mean low yields, so it's directly hitting the profit equation for insurers, and again, I think life insurers in particular. At the end of the day, there's only so much insurers can do to hedge their exposure to this issue. We have seen more and more insurers exploring opportunities in terms of generating additional fees by managing assets for third parties, such as defined contribution assets. So legal in general in the UK is a good example of that. So all bets are off, and certainly we would not intend to make a pronouncement on where the rate environment is moving, although it does seem increasingly likely that the Fed in the US will move to raise rates in Q4. So that should help the US players in the short run. And again, Europe's pension fund regulator, as most of you are probably aware, has kind of weighed in on this and said, look, if this low rate environment persists over the longer run, it could actually threaten the ability of some insurers to fulfill their obligations to policyholders. And I think most interestingly, in the trend that I think is has the most significant ramifications over the longer term is really the proliferation of technology that we're seeing in the insurance sector. And again, like any other industrial sector, you could argue technology is really having disruptive effects. In the insurance business, it's clearly impacting business areas such as claims management, product development, and how premiums are calculated. So essentially what's going on is in our increasingly digitized world, there's a lot more information out there being generated by all types of different devices. And generally speaking, other things being equal, more information is better for insurance companies because it allows them to get more information about their customers and policyholders and really allows them to optimize premium prices. So there's lots of really interesting examples of this. One that certainly caught our eye, and it's too early to say if this is indicative of a broader trend, but one example that we thought was really interesting was a US insurer, John Hancock Financial, actually distributing Fitbits. So this is a well-known pedometer on a voluntary basis to some of its policyholders. And basically, they review the lifestyle habits of their policyholders, and at the time of renewal, if you've been, demonstrated, positive, health behaviors, you get a reduction when it comes to renewing your policy. Conversely, if you haven't displayed those traits, you could be hit with a premium increase. So really, this does have potential in our view to fundamentally change how insurers are pricing health policies. But again, it's really too early to say. We didn't find any other examples of this, but we do expect it will play out in the broader term. And then again, to flag one more example that really caught our eyes is the growing use of vehicle monitoring devices in the auto sector. So a growing number of auto insurers are exploring ways to put vehicle monitoring devices in the cars of their auto policy holders. And again, it provides real-time data on things like average speed, how frequently you come to a complete stop, things like that. So it's much more granular information than insurers have ever had before at any point in their history. And again, it really allows them to optimize their premium prices and figuring out, precisely who is the riskiest category. I would say, generally speaking, though, the market is underestimating a lot of the risks, though, that we see with leveraging this type of data and this type of information. So if we think about data privacy or data security, I mean, these are hugely important issues that probably have been underestimated by the market. It seems you cannot pick up a paper these days without reading about another type of cyber attack. So we're closely following this space, and in fact, we're in the process of populating indicators in our research model to track substantively how companies are performing on this issue. And the fourth trend that we really see having macro impacts for the sector is the aging trend. You can see there in the stat I put up, right now about 12%, it's estimated, this is United Nations data, of the world is over 60, and that's forecasted to grow to almost a quarter, so 21% by 2050. So I think this is going to have a whole suite of new risks and opportunities for insurers. On the one hand, there is an upside because we're not alone in stating this, of course, but it's increasingly likely that national pension schemes, including the one here in Canada, are under enormous strain. So as fewer workers are moving through the system supporting a larger retirement base, there's growing strain on national healthcare and national pension schemes. So this does provide an opportunity for private insurers to step in and offer post-retirement products, primarily health products. So there's certainly an opportunity there. But the big downside that we see is that particularly for those insurers that are in the annuities business and other guaranteed products, they really have to figure out, precise and improve their actuarial tables and figure out how long people are going to live. Because if you're in the guaranteed space and you underestimate the aging trend, you could be hit with substantial liabilities. One stat that caught my eye from Swiss Re was underestimating how long your policyholders are going to live by only 1 year, which would not seem to be a huge error or margin of error, can push up your liabilities by 5%. So the pressure is really on insurers to figure out what this aging trend means for their business. So generally speaking, just to close out, these are sort of the four background trends or macro trends that are playing out across the industry. And I think it's a really important backdrop to consider the ESG issues that we'll be talking about later on in the presentation. And again, maybe it's reasonable to ask, what are the connection points between these macro issues and ESG analysis at a high level, or even more particularly the issues that we talk about. And I would say, at least in the case of interest rates, I don't see a strong connection, but I think in the other cases, generally speaking, these trends are putting increased emphasis on things like corporate reporting practices, transparency, product innovation, and even reputational management and risk management. So these are all issues that ESG analysts are familiar with, and I would argue these are all hallmarks of, or often hallmarks of top ESG performers. So in some ways, I think these trends are going to reinforce the importance of looking at companies through an ESG lens. So for my side of the presentation, I wanted to close out by taking a look at climate change. For those of you that are familiar with our sector reports, you know that in each of our big reports, we do a section called the Spotlight section, where we really drill down on an industry and a single issue. For the insurance report, we took a look at climate change. Again, this issue has been long studied in the insurance sector. These graphs, I think, really help set the stage for the discussion. I mean, the main message here is that loss events in terms of impacts that we normally associate with climate change, so hurricanes, hydrological events, things like that, are clearly trending upward. This is some great data that Munich Re provided us. You can see here that the number of loss events are clearly trending upward. They've gone up from 353 in 1980 to almost 1,000 in 2014. So that's the main message there. But if you look at the proportion of those events that are insured, you can see it's actually much more variable. You can see there in the yellow bars of the bottom graph, this is the proportion of those events that were insured. And in actual fact, despite what we read about how climate change is having increasingly frequent impacts, you can see that insured losses are actually trending downward from a high in 2011. So we think that's also important to take into consideration. in general terms, the major exposure from climate change is with the reinsurers. And I think that's important. Again, it speaks to this issue about thinking about companies through a sub-industry lens, because most property and casualty insurers have hedged their exposure through reinsurance. So Swiss Re, Munich Re, and the other big reinsurers, it's really these companies that are most exposed to impacts from climate change. And it's precisely because of this exposure that these companies have been thinking about and modeling climate change for over 20 years. And again, one discussion we're closely following is the growing market for cat bonds. So this is a hugely interesting market to us. It's essentially a way for insurance companies to hedge their exposure to climate risk. It's essentially an alternative to conventional reinsurance. But what we're finding, again, this kind of ties into the low rate environment, okay? Because investors are under growing pressure to find yield, to find assets that are providing attractive yields. And it turns out that cat bonds actually do that. So they have a pretty good yield relative to sovereign debt in most countries. And they've actually been shown to have a low correlation with asset classes. So pension funds now are increasingly getting into the catastrophe bond game, which we think is fine in principle, but it does kind of raise this issue of whether the capital markets are potentially taking on risk that they may not fully understand. And again, it ties into this issue of how investors are under growing pressure to find high yielding assets. So this is certainly a market that we're closely following. So with that kind of backdrop to the industry, I'm going to pass off to my colleague Silvana, who's going to walk you through the major findings from our report from an ESG issue perspective.
Thank you, Doug. Now we will turn our attention to the materiality matrix and the ESG issues identified for the industry. In line with our research framework, the materiality matrix we have defined for the insurance industry includes all ESG issues that we consider relevant for the industry from a sustainability and business impact angle. Furthermore, we constantly review the ESG issues selected to make sure our research reflects the highest impacts triggered by industry trends. Out of the 6 ESG issues that we have identified for the insurance industry, responsible finance, financial product governance, and business ethics are described in more detail in the report, and I will now briefly discuss them. Next slide, please. I will start with responsible finance, which is our broadest ESG issue and looks at whether and how do insurers integrate ESG factors into their asset management, underwriting, or product development strategies. Our research shows that while many insurers, especially in Europe, are taking steps to integrate ESG factors into their asset management, underwriting, or business or product development business strategies, the industry as a whole has been slow to embrace responsible finance, and company performance shows room for improvement. A closer look at our responsible investment policy indicator shows that still 65% of companies are failing to disclose a policy on responsible investment, while only 10% have articulated a strong statement on the matter. Many laggards are smaller financial institutions that have either not acknowledged the importance of integrating responsible finance in their business strategies or have failed to provide disclosure on the matter. Still, our outlook for the industry is positive, as recent developments such as the Principles for Sustainable Insurance could pave the way for more rapid or active ESG integration. Next slide, please. When discussing responsible finance-related controversies, we can say that these controversies primarily concern the social or environmental impact of insurance products. These controversies typically involve the financial relationships that insurers have with companies considered controversial, such as controversial weapon producers or controversial palm oil traders or producers, or on the other hand, financial relationships that insurers have with projects considered controversial, such as the financing of the Belo Monte Dam which can trigger negative media and NGO criticism. Next slide, please. Our report also took a closer look at Swiss Re's responsible finance initiatives. Swiss Re is one of the reinsurers we cover in our research universe and is considered a best practitioner in the industry. As one of the founding signatories of the Principles for Sustainable Insurance, Swiss Re revised its existing sustainability risk framework back in 2013 to better align it with the PSI requirements for both its underwriting and investment procedures. As such, the company filters all proposed business deals through its internal due diligence process, which also takes sustainability criteria into account. In 2013, approximately 13% of proposed deals were rejected on the basis of sustainability criteria. At the same time, Swiss Re provides mandatory training to employees as the company considers it to be the ultimate employee responsibility, the identification and elimination of potential ESG risks associated with incoming business transactions. Next slide, please. The next ESG issue that we looked at is financial product governance, or the industry's approach to customer relations. Our report focused on illicit pricing strategies, anti-competitive behavior, or the refusal to pay legitimate claims. Our analysis began by discussing the regulatory changes in the industry, changes which are directed towards customer needs and increased customer protection. These changes are currently impacting the insurance product governance through increased regulatory restrictions or fines and reputational damage in case the insurers fail to comply with the new regulations. Over time, insurers have been criticized for their aggressive strategies to pursue financial gain at the expense of their customers. As such, one of the greatest challenges for insurance is rebuilding customer trust after a period of disruption. Leaders and steps demonstrate their financial product responsibility by continuously monitoring and assessing the social impacts and risks associated by their product to customers. Overall, our analysis shows that the industry's performance with regard to product governance is generally improving, which is evidenced by the declining number of related lawsuits and controversies, and we expect to see continued action by insurers on this issue. Next slide, please. When discussing financial product governance controversies, it is important to note that quality-related controversies are the most common, where companies are often implicated in customer lawsuits over excessive premiums or excessive delays taken to respond to claims. At the same time, controversies related to anti-competitive practices are also relatively common in the industry in both developed and emerging markets. However, insurance companies are mostly involved in low or medium level cases and are free from category 4 or 5 controversies. Next slide, please. Lastly, the third ESG issue that we analyzed is business ethics, or the company's exposure to illegal business practices such as bribery and corruption, or insurance fraud, or tax evasion. Companies that deviate from industry norms on any of these issues risk potentially long-term brand and reputational damage. As an example, we have American International Group, which is the most well-known case in the insurance industry, and its reputation is still recovering by effects from accounting irregularities discovered in 2005. With regard to business ethics, this seems to be an area where many executives have recognized the importance of maintaining high standards. According to a recent PricewaterhouseCoopers survey, approximately 62% of CEOs are actively trying to establish and maintain a strong ethical culture. Our research shows that insurance companies are increasingly recognizing the importance of maintaining a strong ethical culture, especially in Europe and North America. Leaders such as Storebrand in Europe or Prudential Financial in North America present strong preparedness to mitigate potential ethical risks. Finally, we have a positive outlook on the industry's ethical performance, and although insurance companies will probably not be able to eliminate ethical breaches, the industry's overall performance on these issues appear to be on an upward trend. Next slide, please. The ethical controversies overview underlines the fact that the industry lacks Category 3 or higher controversies. However, despite this strong performance over the past 3 years, the insurance industry is still highly exposed to ethical risks, and the most important issues are in the area of business ethics general, such as insider trading cases or selling insurance policies without a license, or accounting and taxation issues, or, for example, bribery and corruption controversies. Lastly, the industry as a whole seems to be engaged in resolving previous ethical issues in both developed and emerging markets. This can explain the declining number of related controversies from our research universe. Next slide, please. A closer look at the insurer's ESG performance over the past 3 years shows that Europe is home to an array of top-performing companies, with 9 out of the top 10 companies pertaining to this region. South Africa stands out for its strong performance compared to non-European regions, and Sanlam Limited exemplifies this very well. Of the sub-industries that we cover in our research universe, insurer brokers and property and casualty insurers are currently lagging the other sub-industries due to an overall lack of sustainability reporting through their investor communication tours. On the other hand, we have reinsurers, which present the highest concentration of top-performing companies in the top scoring range. When discussing controversy, our controversy research shows that insurers are free from highly severe cases, such as controversies of Category 4 or 5. Only a handful display controversies of Category 3, and the vast majority are involved in minor cases. Overall, we can say that the insurance industry shows a constant performance improvement over the past 3 years across all 3 themes: environment, social, and governance. This is due to improved ESG commitments through policies and programs, backed by a decreased involvement in controversies. Lastly, our sector report found a moderately positive correlation between market cap and company performance, which can be explained through the fact that bigger companies have more resources available to devote to sustainability programs compared to their smaller peers. However, we also found some exceptions of lower cap players, such as Storebrand or Delta Lloyd, which are outperforming their larger peers within their specific sub-industries. Next slide, please. To wrap up, the insurance sector report dives into the industry's emerging trends and discusses the risks and opportunities triggered by new regulations, by low interest rates, triggered by technological developments and aging populations. We then turn our attention to climate change, and we describe some innovative steps taken by the industry to create climate-driven insurance solutions. Moving forward, in the short to mid-term, we expect to see new innovation in this area. At the same time, in the report, we focus on the 3 ESG issues that we consider to be of significant importance for investors due to their potential ESG impacts. We focus on responsible finance, financial product governance, and business ethics. Lastly, When discussing company performance, we conclude that European companies such as Allianz, Storebrand, or Swiss Re lead the way with strong ESG commitments. Next slide, please. And with that, I would like to turn it to you, Niamh.
Okay, excuse me. Thank you very much, Silvana and Doug, for a really interesting presentation. We seem to be getting some nice questions coming in. And to start with, I think I would like to go back to some of the very intriguing macro trends that Doug mentioned at the start of the presentation, and that indeed are discussed in some detail in the industry trends chapter at the start of the sector report. I will direct this question at you, Silvana, but Doug, if you would like to step in to add to anything that Silvana says at the end, please feel free to do so. One of the very, very important trends, macro trends, that seems to be affecting the industry at the moment is the whole data privacy issue. It's so important that one might actually ask why it wasn't developed into an ESG issue in itself. I was wondering if you could elaborate for the listeners on this point, please. Why was that the case? And are we thinking about maybe establishing it as an ESG issue in the future?
Yeah, this is a very good question, Niamh. Thank you very much. Indeed, over the past years, we have recognized the increasing importance of technology for the industry, and as such, we have added the issue to the materiality matrix. Moreover, we are currently busy with building and updating new indicators regarding data privacy and security to reflect the industry's preparedness to deal with potential risks. For the moment, we consider that the sector report describes in detail the emerging risks and opportunities triggered by data privacy and security, and for the next edition of the report, we will look into selecting this ESG issue and also discuss company performance on the topic.
Okay, so there's very interesting times ahead by all accounts, and it's nice to know that we're developing these indicators and that we hopefully will be ahead of the curve when it comes to this sort of analysis. Doug, would you like to add anything to that particular point?
No, I think Silvana covered it well. I mean, we definitely see it as one of the major macro trends playing out in the industry, and I think it'll be increasingly important for investors to think about how their insurance holdings are positioned on this issue in terms of how robust are their policies and programs, training, things like that. You know, it's not all an opportunity side of the equation. Having access to this data also presents risks.
Absolutely, very good, Doug. Actually, while I have you now, I think it's a good opportunity to maybe move on to some more of the company performance-related data and analysis in the report, which of course is of most importance, I would imagine, for the listeners today, the institutional investor listeners that we have on the line. And Doug, if some of these investors are looking at the report, they might notice that some companies are actually performing well when it comes to one particular ESG issue, and they may not be performing as well when it comes to another. How should they interpret these particular scores? Should these differences in scores cause them alarm? How should they approach the reading of these results?
No, I don't think there's any cause for alarm. I mean, really, there's two sets of scores that we provide in the report. For instance, in the executive summary and elsewhere, we provide the overall score for a company. This is pulled directly from our research platform, and it's an all-encompassing measure of a company's ESG positioning using the indicators that underpin our model. But then, as we've gone through in the webinar, the real analytical thrust of the report is issue-specific. So on these particular issues, we take different baskets of indicators and mix and match them to come up with a best attempt to gauge companies' exposure to these individual issues. And on that front, no, I don't think it necessarily presents any cognitive dissonance. For example, if you have a really strong performer overall, could have some weak spots or could have potentially been hit with some recent ethical controversies or things like that. I mean, as one example, I mean, Allianz obviously performed very, very favorably in our model overall, but they have faced criticism for their coal financing portfolio. So I don't think that's inherently problematic. But just to close out, I would say though that I haven't run a regression to test this, but I would guess though that probably the top overall performers, I think probably perform sort of above average on the issues we do look at.
Okay, great responses, Doug. Very insightful, I think, for our listeners today. Staying on the topic of company performance, Silvana, it's very clear that the European companies are leading the pack at the moment. Why is that?
Yeah, indeed. European companies seem to be leading the way across all three themes, ES and G. And in my view, this can be explained through increased customer pressure on sustainability matters, backed by more stringent regulations. Consumers in Europe seem to have started earlier to inquire financial institutions about their business practices, and awareness levels seem to be higher here.
And why did they start earlier? If you're looking at the likes of store brands, Swiss Re, Munich Re, I mean, what prompted them to start to focus on sustainable insurance, responsible insurance issues?
Yeah, well, they're also bigger, so there's much more attention on them and on their activities, and media was also watching them, and NGOs. So that is what I think pushed them to start earlier.
Earlier in the 1990s,
exactly.
Early mid-1990s. And you would have seen, of course, that these particular insurance parties would have been at the forefront of the development of UNFFI work on insurance, for example,
exactly.
as well. So it's, I suppose it makes sense then that they're still leading the charge right now.
Exactly.
On that particular note, though, for listeners, is there any particular new, for example, leaders that have made significant strides when it comes to ESG performance over the last maybe 1 to 3 years that investors should watch out for over the next year or so?
Yeah, next to the companies that we describe in the company portrait sections of the report, I will mention the Dutch insurers, Delta Lloyd, Aegon and Achmea. And the Netherlands is an advanced market for responsible investment, and these Dutch insurers are standing out currently for their strong performance through policies and programs on responsible investment that apply to all asset classes. And also next to the Dutch insurers, I would mention the French AXA or CNP Assurance, which have improved their performance significantly over the past 3 years.
Okay, interesting. That's great. And when it comes to emerging market companies, you mentioned Sanlam was the leader. Can you elaborate a little bit on why it is?
Yeah, I would say that Sanlam can give a lesson or two with regard to business ethics compared to the other insurers from the world. And they have a very unique emerging markets governance framework policy, which focuses on embedding business ethics within new partner organizations. So they first assess the business framework that exists within new partner organizations, then they identify gaps, and then they try to help new business organizations to develop appropriate procedures, such as whistleblower channels or some policies.
Very good, very good. Is there any other emerging market player that we should look out for?
Well, next to Sanlam, there are other South African companies that stand out for their progressive sustainability programs.
And we go into that in some detail in the report also?
Yes.
Yeah, exactly. That's great, Silvana, thank you. We've just got a nice question in going back to maybe some of the other macro trends. Again, it relates to resilience. The question is stating, if regulation is affecting the industry so much, then why is resilience, for example, also not an ESG issue? Would you like to take that one first, Silvana, before we pass over to Doug?
Yes, I would like to take this one. Thank you. Yes, indeed, we have been discussing resilience quite intensely in the insurance team. And as currently the capital requirements for insurers have not been set out, we decided to wait until these requirements are out there, and then we will be busy creating indicators to capture the resilience of insurance companies. And also we're going to apply the same strategy for the reinsurers. So we're waiting also for the reinsurers list to be defined.
Great. So participants and listeners today should wait and see.
Yeah, wait and see. Yeah,
very good. So we're aware of it, and we're going to hopefully address this issue as soon as possible.
Exactly.
Yeah, Doug, would you like to add anything onto those points?
No. I think Silvana nailed it. I think there's always a bit of a delay in terms of what goes on in the market, and then our ability to capture and measure what's going on in the market. and it's really important that we don't rush in, so we need to first build out the indicators before we make them available.
Okay, that's great, Doug. Just another question on technology developments, the macro trends, Doug. Is there anything else that you would like to elaborate on when it comes to customer-related issues and technology there that you may not have a chance to, or you did not have a chance to elaborate on in the presentation earlier?
Sure. I could talk a long time about technology in the insurance sector. It's truly it's disruptive in the truest sense. So, I mean, one way to think about it is in terms of benefits for customers versus benefits for the companies. And certainly, while we are sensitive to the risks, certainly there's a large opportunity part to the equation. So, if you think about how technology is bringing down barriers to insurance market, and particularly in the microinsurance segment, so companies now are using cell phones. And allowing customers to transact and make transactions using their cell phones. This is really helping to boost the supply of microinsurance, particularly in emerging markets. Certainly from an efficiency standpoint, you can argue that it's really helped improve the efficiency of claims management. And this might be a stretch, but you could even also argue that this whole big data trend we talked about, while it does present concerns, it probably does present an incentive for customers to become healthier and drive more safely. Because if you know that your behavior is going to be factored in in a more granular way to the premium prices, that does send a market signal. So I think it does provide an upside for customers too.
That's great. I mean, many of those microinsurance issues there that you mentioned are very, very important when it comes to the whole access to insurance debate, and certainly I would imagine have direct impacts on responsible finance and product governance, ESG issues and developments over the next few years too. So they're also interesting spaces to watch. Following on the line of this focus on customers for the moment, Silvana and Doug, you also mentioned, and I'll direct this question at Silvana first, that customer trust. Now, insurers are really trying to improve customer trust again post-financial crisis, trying to improve their reputation. How do you feel that companies are gaining ground in this area? I know you mentioned in the presentation that Old Mutual and Storebrand, for example, have been actively looking at these issues. Could you elaborate more on how they are, please?
Yes, sure. So we see that the industry's players are reacting to more stringent regulations and are improving their approach towards customer relations. Over the past 3 years, insurers have taken measures to improve their communications with customers and are active in conducting regular customer satisfaction surveys. What the industry as a whole is still missing, and we expect to see moving forward, are continuous monitoring systems of the social impact and risks of product offered, as well as integrating customer feedback in their product development process, which can of course contribute to higher loyalty rates. As I mentioned before, companies such as Storebrand seem to be moving in the right direction.
Great. Is this currently being reflected adequately, do you think, in their responsible finance and business ethics scores, or is it too early to say?
Yeah, I think at this moment it's too early to say, but we're working on developing new indicators. We actually have developed some for financial product governance and looking what they actually do for their products, for their customers.
Okay, great. Sticking with responsible finance for a moment, you provide a positive outlook in the report when it comes to responsible finance. But looking at the figures, Silvana, there's only 10% of the companies covered, 149 companies, that actually have a strong responsible investment policy. And indeed, 65%, you noted, are not actually disclosing any responsible investment policy. I mean, are you being a bit too positive, a bit too optimistic?
I sure hope not. Indeed, these are quite clear numbers, and I would say that I repeat what I mentioned in the presentation, that many of these laggards are smaller financial institutions that do not provide disclosure on the matter. And our research also focuses on transparency, and a lack of transparency would also impact the score. And we also this is backed by the fact that these companies do not have controversies, so there's not much information on them on any front.
Okay, these are very interesting points here. So you're saying that basically a lack of disclosure is not necessarily indicative of a lack of awareness of responsible finance issues, or indeed a commitment to try to address them as well.
Not at all. It's just that they don't report on the issue.
Yeah, and why is that, you think?
I think it's probably due to size and culture from the region they're coming. So emerging market companies, it's not that advanced, the understanding of sustainability and responsible investment. And also, yeah, we have some companies coming from North America, smaller companies that do not have still, the conversation is not maybe in the boardrooms at the moment.
Is there anything that investors can do to try to catalyze more disclosure from, for example, some of the sub-industries you mentioned in the presentation?
I think engagement with these companies is very important. We have an example of a company from Taiwan, Cathay Holdings, which has started to provide exponentially increased disclosure after investors have engaged with them.
Okay, great. So there's nice business cases there as well to try to develop this. A win-win situation for all, it would seem.
For sure.
Very good, very good. Okay, we have another question here that has come through. Bear with me while I try to read it out. It's from a lady called Emily Lambert. I will read it as it has been written here, so if it's not very clear, then my apologies in advance. The question is, some research has found correlations between poor financial performance and company focus on immaterial ESG issues, likely illustrating poor resource allocation. What issues do not have a large materiality impact but have seen substantial activity in the insurance sector? Doug, would you like to take that particular question?
Sure. Yeah. I mean, I think this is probably in reference to the HBS paper that was quite a seminal work in our field. The work that Professor Serafim is doing. So I am familiar with the research, and yeah, it actually is hugely insightful. This is correct. It does show that companies that have a focus on relatively immaterial issues from a materiality standpoint have a correlation with poor financial performance. I would say, yeah, I mean, definitely this is where the space is heading. So this growing discourse on finding and focusing on ESG issues that do have material impact. I think it also speaks to what we talked about in the webinar, which is to really drill down and think about companies not from a sector perspective, but from a sub-industry perspective. So in the insurance sector, I'm not a subject matter expert, and Silvana might have some insights on this, but I can certainly think about sustainability reports I've seen in the past where insurance companies are talking about things like internal energy efficiency measures or programs to boost workforce diversity, and these are not unimportant, from a broader sustainability perspective. Are they likely to have material impacts on the company? Probably not. Certainly compared to where we see the real action taking place. So thinking about integrating ESG factors into underwriting processes or strategies to manage customer relationships, things like that.
Okay, that's great, Doug. Conscious of timing, we're almost 5 minutes to the hour. Just to close out, and Doug, while I have you, I will continue with you. It's obviously a very important year. We're working towards COP21 negotiations in Paris in December. In terms of the insurance industry and climate change, how are insurance companies addressing climate change? Is it proactive or reactive, in your opinion?
Again, I'm going to sound a bit like, repeating myself. I think it really does depend on the sub-industry classification. So if we're thinking about insurance brokers, I don't think they've done much. And that's probably with good reason, because they don't really face material impacts from the issue in my view. But if we look at where the exposure lies in the reinsurance segment, for the most part, they've been hugely proactive on the issue. I would say there's still room though for even more work to be done, but they've been strongly advanced on this issue. So companies like Munich Re and Swiss Re. So how are they doing it? All types of ways. I mean, thinking about product innovation, directing investments to green sectors and things like that. I mean, obviously we took notice when AXA recently made its divestment announcement and channeled reinvestment into green industries. So the impacts are quite wide-ranging, but again, it really does depend on the sub-industry.
Very important points, I think, for our listeners again today, Doug. Without further ado, I would like to thank Silvana and Doug for a really great webinar session today. Thank you also to all the participants. Thank you for your questions. It made for a very interesting Q&A, I think, also. I would like to highlight that this is but one of the sector reports that we produce in Sustainalytics, and that we have periodic webinars associated with the launch of these sector reports. So please keep your eyes and ears open for our future webinars. As I said at the beginning, this particular webinar has been recorded and will be sent to all of you. And if you have any follow-up questions that you didn't get a chance to pose today, then please feel free to send them through to Doug or Silvana, and they will address those as soon as possible. So thank you once again, and I look forward to having you join us on our next webinars. Bye-bye.